Hey guys, Mike here. So, oh boy, what a day in the market. You got Tesla shooting to the moon, double digits. You got this economic data coming out that it could bring us down. Oh my God. Or it could really make us moon, right? Oh, we'll have to see. And then, shockingly, it seemed like the S&P hit a wall somehow this morning. I don't understand what happened with that. I'm going to explain that one to you. Then we're going to go over the Qs. There's a few things you need to look out for because that one has just been on an absolute rip-roaring tear up double digits just this month alone. And then we're going to go into something to watch out on the SPY because if you're looking to get into stocks, this one could give you a better entry point if it plays out like it did before. We'll have to see on that. But getting into the news, the economic news, you can see GDP 2.9% in Q4. Everybody's all pumped. And this is something I want you to look at very closely. When I tell you it is all about us, this is what I'm talking about. Consumer spending makes up 70% of GDP, 70.6 to be exact. And you can see from Q1 last year to Q4, we're still holding up. We're still spending. We still got the gravy train going from all the government money we got, the money we made in the stock market and crypto and all that good stuff, right? Then there's government spending. Why you will never, ever hear them talk about a balanced budget again. 17%. Look at that in Q4. 3.7. Third quarter, 3.7 as well. So, yes, that's why your tax dollars and the credit card will continue to be swiped and used up, even if it is being spent on useless stuff. That's what's going to happen. That's why it's going to happen. Just look at the federal level. 6.2% in Q4, up 3.7% from Q3. Then, of course, we got the jobless claims. Oh, my goodness. Look at that. Still got a hot job market, 186K. And so, of course, the market should have tanked, right? I mean, we still have a hot job market. That means the Fed's going to have to continue to tighten. Oh, my goodness. That was the narrative, right? No more, right? Don't care about no hot job market because guess what? I always say it. We still got paychecks coming in, still getting paid, still spending. Swipey, swipey, swipey. That's what we're doing. Okay, that's the way it is. Those airports are completely packed out. Cruise ships are looking good. Everybody's doing their thing. Okay, and so don't matter. And what we ain't spending, the government's gonna make up for us. Okay, that's just the way it is right now. And right now, unfortunately, I can get into 30 minutes on this, but I'm not. The Fed has totally lost control of this market. They have totally lost control of the narrative. And unfortunately for them, that's just the way it is. Unfortunately, for us in a way. But hopefully they'll come out with something. We'll see on the first, and you're going to know about what they talk about because if they only do a 25 basis point hike and talk the same stuff they've been talking, this market could absolutely continue to keep going, and commodities could continue to keep rising. And so, if we have to get back into an inflation problem, it is what it is. I mean, don't forget who's running the country. Pretty incompetent people, if you ain't noticed, right? And so, don't surprise me. Let me know what you think down in the comments. But if they don't come out and do 50 and shock the market, I'll let you know. That kind of sends you a signal of where they're at right now, okay? And they might be throwing in the towel on it, and they're just going to say, we're going to have to see what these interest rate hikes really are going to do, because right now they're not making much of a dent. That's just the way it is, right? Right now, the labor market's still hot. We're still getting paid. The government's still spending like crazy. And so it is what it is, right? And so going into the Qs, as I ain't talked about this in a while, is that, some pretty important things you need to understand. One, sitting right at that 200. Hadn't been at the 200 since April. Been a long, long time. The other one's this trend line right here. Obviously rejected off of it 3 times. Going to be coming up to that real soon. I think it's like 2% away. So if you can break above that, retest, turn that in support, it's huge. Still, even after a massive, let me not understate this enough, run up in 1 month, this thing is still not overbought, right? I mean, that chart looks beautiful if you think about it, because what do you see on this run up? Higher lows, higher highs, right? And so, and again, everybody's in the high beta right now, which can turn on a dime. We all know that. But what's something else we got to look at? The Fibonacci level, still well below the 618, right? So if it breaks above that trend line, then we'll see. Of course, it got rejected at the 0.50 Fibonacci level the last 3 times, it looks like. And so we'll have to see, but it's not far off. 4% from 618, where maybe you get reversals, but it's, what to see on that one. The other thing is, look, we're still sitting here when all said and done in this chop box. In this box right here, we've been in since September. It's about 1% away from it. If it can break out of this, right, and finally get out of it, again, another bullish signal. And if you're new here, please hit that subscribe button. Really appreciate it. And if you're getting anything out of this, please hit the like and think about sharing the video, guys. Now, that brings us to the S&P. And we're going to go over a few things on this. I'm going to show you one thing, be careful for, and see if this actually plays out, so pay close attention. Right now, though, what do you see? We end up breaking, in my chart at least, above that descending trend line, and we've stayed above for a couple of days now. That's the weekly range up there. I think it's like 406. I hadn't updated this today as far as what the options market is expecting, but we're still below it. And so, and you see we're like in this megaphone pattern now. It's been widening out. It's rejected off of it multiple times. So it's kind of resistance right now. We'll have to see if we break above that. Again, that's the big number right there. I think it's 410 for the SPY. What I say, 4100 for the S&P. That's that double top. You break above that. Again, that's another bullish indicator. And then, and going to a smaller time frame, you notice we rejected off 404 today, right? Keep that in mind for a second. But more importantly, what do you see happening? Like today we gapped up, boom, filled the gap, and then immediately took off, right, to the penny. What do you see back here? Gap down, immediately filled the gap, started taking off the next couple of days. Up here, we gap down, immediately filled the gap within the same day, which is actually a bullish thing, right? And the reason why I told you to pay attention to 404 is I put this out this morning. Once again, max pain 398, don't worry about that. But the SPY is set to open around 403. The most puts are expiring today at 395 and calls at 404. The optimal market range would be 395 to 404. And what I said was with the momentum and with the earnings out of Tesla and stuff like that, I'll be surprised if we don't break 404 today. And again, tomorrow, the calls are around between 410, really what you're looking at. And all I did was look at this right here. 404 is the big one, right? Sitting right there. And what do we end up doing all day? We end up going up to 404, rejecting right off of it, almost to the penny, selling down, and then melting up all day. And then in the last 30 minutes of the day, breaking above 404 and closing. Why is that important? And why do I always look the day ahead? Tomorrow is Friday, right? This is bigger options expiring, the weekly options, that is. And what do you see? Well, there's 404 all of a sudden. It drops down, right? Ain't that big spike anymore. 405 and 410 become your bigger number of options we have to look out for. We're obviously below 405. We're definitely below 410. So that, and again, if you look to the left, whole bunch of puts, which we're not going 395 and on down. That's just not going to happen. But one thing to look out for as well, this is the hourly on the SPY. And what do you see happening here? Some bearish divergence from the RSI, right? It's setting higher or lower highs, excuse me. The SPY, though, is setting higher highs. This happened just on January 12th through the 19th. You saw that it's setting lower highs. And what was the SPY doing? It was setting higher highs, and they end up having like a 3% drop off in the SPY. And I believe the stocks obviously went down farther than that. And that's important to know. And the other stuff is important to know. And I have people send me emails about this, right? And yes, traders use this. It's great for traders because they can see where there's probably going to be a rejection at or a bounce or whatever. And same on the RSI, they look at that and go, okay. But even if you're investing, guys, remember, it's about compounding. That's the name of the game for your whole life, right? And it's kind of like, for example, if you're going to buy a stock and you look at it and say, wow, some negative RSI divergence is coming into overbought already. You look at there's a call wall sitting, say it's sitting $1 or $2 above where you're trying to buy right now. You can look at that and say, wait a minute, why don't I just wait for confirmation here, right? Well, I mean, this don't seem like a time I want to be buying this stock right now, and I can just wait a few days probably, and it sells off, and I can get it for 2%, 3%, 5% cheaper, something like that. And I assume you plan on making multiple purchases of this stock. And of course, we're talking about just one stock in your portfolio, not all of them. If you're talking about all of them, imagine throughout your life, you're able to use just simple knowledge like that to say, oh, I'll hold out. Let's say it sells down 5% and you buy the stock, right? So you got it for 5% cheaper. But you do that over your whole life, how much money did you just compound versus just blindly just buying? That's just the question I have. Put down in the comments what you think. Maybe I'm totally wrong. But that is simple stuff. It's free stuff. It don't cost any money to see any of this, okay? And so just putting that out there to you. And you don't even have to go look at it yourself. There's plenty of channels that cover it, And so just paying attention to that. You don't know and stuff. But again, just putting it out there to you. Now, go over into earnings, right? Tesla obviously rocketed. And I can go in a whole thing about Tesla. But the real reason they rocketed, in my opinion, was this one right here. The vehicle delivery growth rate, which they put out. Assuming 50% compound annual growth, this is what they're putting out for 2023, and that's a big jump. This is what people were worried about. But according to Elon, the demand is so big now because when they did those price cuts, a lot more people can afford them. And so they're even thinking about maybe raising prices later on. Now, whether that's true or not, who knows? I mean, a CEO is not going to go in there and just, bag on their company. So we'll see if that actually ends up being the case and stuff. And they were saying, they can make the delivery numbers and everything else. And so, we'll see if it happens. Obviously, it depends on the economy and depends on us, right? If we don't have the money, if the layoffs do continue to spread and continue to happen, then no, that's probably not going to happen. But right now, we're still spending. I'm sure there's people out there who will go buy Teslas, right? Let me know in the comments if you're one of them, by the way. And so other earnings tomorrow, let's see what earnings can bring down the market or run it up. Well, I'm going to go with none. But what we have is Chevron, another CEO from an oil company, going there bragging and everything about how they're not going to produce more, and oil prices continue to stay high for us. American Express, how are we actually spending? We'll have to see. I think Visa and MasterCard, I know MasterCard did good. Visa will probably do the same today. And then healthcare, HCA is a pretty big stock, big company, so we'll see what they got to report and stuff. And then as far as the data, like I said, if the data today wasn't going to tank the market, maybe tomorrow we'll see if they use it for a reason to sell off and stuff. But core PCE, price index, personal income, personal spending is going to tell us all about us, right? Pending home sales, and I believe new home sales were actually up today. So pending home sales probably went up too. I mean, according to a guy I know in the business, I talked to a lot of people trying to get information for this channel, and he said, yeah, he did way more applications already in this month than he did in December. That's for sure. And so, with those rates dropping, they've dropped from almost 7 to 6.18, but he said he even got somebody in at like 5.8, so below 6. And so, yeah, that won't surprise me a bit. We get to find out about our spending habits. I think we're still spending, and of course, when you take out inflation, is it as much? Probably not, but nobody's even looking at it. I mean, the market don't care about that right now. So, we'll see. We're just going to see. And I think I heard somebody say when they asked Mike Wilson yesterday during an interview, has the consumer held up so much more than you thought? And he was like, yes, absolutely. And I was even thinking about that today. I was like, imagine if somebody told you in January of 2022, last year, by the end of December, the Fed is going to raise the Fed funds rate from 0 to almost 5%. They're going to do 475 basis point hikes, which they've never done in the history of the country. Start rolling the balance sheet off. Going to take QE away, basically do the opposite. And by December, the Dow is going to be barely down, and the S&P and the Qs are going to be roaring back up since October. And then in January, they're just going to take off to the moon, right? And financial conditions are going to loosen, like we're doing QE again or something. And unemployment, by the way, during all of those rate hikes and everything else is going to be 3.5%. How many of you would say, if that was you in January 22, say, yeah, it sounds about right? Or say, ain't no way. Let's be real. Nobody would have thought raising rates this fast, running off the balance sheet, and then basically taking the gravy boat away, or whatever you want to call it, would sit there and result in 3.5% unemployment and a stock market just going crazy in January the very next year. I mean, there's no way, right? I mean, I know some people say, I knew it, but those people are full of it. I'm sorry, they just are. There'll be 3.5% unemployment. Come on, no, because nobody knew about the job market like this. Nobody did, right? And so it's throwing everything off, guys. That's the way it is. Again, could it fall off a train? Eventually, you would think, right? But we'll have to see. So let me know in the comments what you're doing. Hit the like and subscribe button if you get anything out of it, and I'll see you tomorrow.